The other thing that wealthy people tend not to invest in is commodities, mainly because a lump of gold will always be a lump of gold. It does not produce an income, and there is no management team trying to turn it into two lumps of gold. Although arguably commodities can be useful for inflation protection, wealthy people prefer to get that protection via investing in productive assets like businesses. And for downside protection, they prefer to use things like hedge funds. But before we get into them, let's first talk about private equity. These are holdings in private businesses that do not trade on a stock exchange. Businesses like SpaceX, Revolut, or anything down to just a small chain of dry cleaners. In theory, private companies should have higher expected returns than public companies because they tend to be smaller, have a higher chance of failure, and are illiquid. They are very hard to sell, and investors should demand higher returns for these additional risks. However, unlike with public companies, there is no index that you can invest in that will give you exposure to all private companies and capture the average return of the sector. Instead, you have to invest directly into individual companies yourself or through actively managed private equity funds, of which there are two main categories: venture capital, which focuses on small early stage companies, and buyout private equity funds that invest in larger, more established businesses.